Before a bank gives you money for a home, a car, or even a business loan, they want to know one thing. Can you actually handle more debt? And the magic number they look at is called your debt-to-income ratio, or DTI. Today, we're breaking down what DTI is, why it matters, and how you can use it to take control of your financial future. Stick around, because by the end of this video, you'll not only know your own DTI, but you'll understand how lenders see you and how to improve your chances of getting approved for that next loan. Part 1, Story. Meet Daniel. Daniel earns $4,000 a month before taxes. He has a car loan of $400, a student loan of $300, and a few credit cards that take another $300 each month. Now, Daniel wants to buy a house. He finds his dream home, goes to the bank, and guess what? The lender says, "Sorry, Daniel, your DTI is too high." Daniel is shocked. He has a stable job, pays his bills, and even saves a little. But the bank looks at his numbers differently. To them, Daniel's debts eat up too much of his income, making him risky to lend to. Daniel's story isn't unique. Thousands of people get turned away every year because they don't understand their DTI. Let's make sure that's not you. Part 2, what is DTI? Debt-to-income ratio, or DTI, is simply the percentage of your income that goes toward paying debts. Here's the formula. Backhand index pointing right, DTI equals total monthly debt payments divided by gross monthly income times 100. Let's break it down. Total monthly debt payments include your rent or mortgage, car loan, student loan, personal loans, and minimum credit card payments. Gross monthly income means your income before taxes, not what actually lands in your account. So, if you pay $1,000 a month in debt and earn $4,000 before taxes, DTI equals 1,000 divided by 4,000 times 100 equals 25%. That's good. In fact, lenders love to see DTIs below 36%. Once you cross 43%, many lenders shut their doors. Part 3, why DTI matters. Your DTI is like your financial report card. Banks look at it to answer, can this person pay me back comfortably? Think of it like lending money to a friend. If they already owe 5 other friends money, would you feel safe lending them more? Probably not. That's exactly how banks feel when your DTI is high. A low DTI means easier loan approvals, lower interest rates, better terms. A high DTI means rejections, higher interest, less financial flexibility. So if you're wondering why your friend got approved for a car loan while you didn't, it might be because their DTI looked better to the lender. Part 4, mini story. 2 friends. Let's compare 2 friends, Sarah and Michael. Sarah earns $5,000 a month and has debts totaling $1,500. Her DTI is 30%. She walks into a bank and gets approved for a mortgage with a good interest rate. Michael earns the same $5,000, but has debts totaling $2,700. His DTI is 54%. He applies for the same mortgage but gets denied. Same income, different results. Why? Because lenders trust Sarah's financial breathing room more than Michael's. The difference wasn't in their paychecks, but in how much of their paycheck was already spoken for by debt. Part 5, how to calculate your DTI. Interactive. Now it's your turn. Let's calculate your DTI together. Step 1, write down your monthly debt payments. This includes rent or mortgage, car loan, student loan, personal loans, credit card minimum payments. Step 2, add them up. Step 3, write down your gross monthly income, your paycheck before taxes. Step 4, divide total debt payments by your income. Multiply by 100. That's your DTI. Part 6, how to improve your DTI. If your DTI is too high, don't panic. There are ways to bring it down. 1, Pay off small debts first. Knock out a credit card with a small balance to free up monthly payments. 2. Increase your income. A side hustle or extra hours can lower your DTI since income rises but debt stays the same. 3. Avoid new debt. Don't take out a new loan if you're already stretched. 4. Refinance or consolidate. Sometimes lowering interest rates reduces monthly payments. Even a small change, like reducing a $200 monthly payment, can move your DTI from risky to safe. Part 7. Final story. The turnaround. Remember Daniel from the beginning of our story? The guy who got rejected for his mortgage? Well, Daniel sat down, looked at his DTI, and made changes. He paid off one credit card completely, refinanced his car loan, and started a weekend side hustle driving for a rideshare app. Within a year, his DTI dropped from 48% to 33%. He went back to the bank, applied again, and this time, approved. That's the power of understanding and managing your DTI. Conclusion plus call to action. So here's the big takeaway. Your debt-to-income ratio isn't just a number. It's your financial reputation. Lenders care about it, but so should you. If you want to win with money, keep your DTI under control, aim for under 36%, and watch how doors start opening for you financially. Now, I challenge you, calculate your DTI today and share it in the comments. And if this video helped you, hit that like button, subscribe, and share it with someone who's thinking about buying a house or a car. Remember, your money should work for you, not against you. Thanks for watching. Don't forget to like, share, and subscribe.